Welcome, everybody. This is our first edition of Thursday Thoughts. I'm really excited to do it. We are not experts at this stuff, but we're trying to learn, trying to bring you guys good and valuable content on a regular basis. So have a little grace with us as we go through this. We are going to try to touch on a few important talking points. But before I get there, I want to remind you guys to like and subscribe so you don't miss any of our videos. We have a bunch of good stuff coming down the pike. Cole has some cool CFGU content coming that's going to provide us some pretty special information, or provide you guys some special information, some proprietary content on financial planning topics that can be pertinent to you and your kids and anybody else out there that is interested. It's going to be free and it should be really, really interesting. So without further ado, we are going to jump into this stuff. We have some pretty important data points we want to cover. We're going to go through the data signals we had on our Monday morning minute this week. And the first piece that we're going to cover is our existing home sales. That was the first data point, if you remember, from the Monday morning minute this week. Really, really interesting information coming out. We had terrible information, rather. And keep in mind, this chart shows an 8.5% decline, which on the surface doesn't seem as bad as it could have been. But this is the March data. This only takes into account about 2 weeks or so of the shelter-in-place restrictions. And more importantly, I think it's important to note that real estate agents are considered essential. So people are still trying to sell homes. And with less than 2 weeks of full shelter in place, we saw an 8.5% decline month over month in home sales. So that's not exactly exciting stuff. On Wednesday, we got the existing home sales, or excuse me. This is what I was talking about. This is supposed to be a home price chart. Well, we don't have it, but what I'm going to tell you is the February home prices were actually up about 0.74, but the key word there is February. This chart that I'm showing you right now is the one we just looked at for home sales that went through March. We saw a decline, but if you see the previous month, that was about a 6% increase. And that coincides with the 0.74% increase in the February home price data. Okay, so that's important stuff to see, because the market was still reasonably stable and still pretty strong, which is to be expected with good, really solid unemployment rate like we had around 3% before this whole thing blew up. This morning, we got the jobs data. This is the one I told you we had to look out for. The people on TV are telling you that the jobs data, at 4.25 million of additional jobs lost was no big deal because it wasn't as bad as we expected. But what I have right here is from 2010, fast forward 10 years later, we had 23.3 million jobs created. So this massive, incredible bull market that has been one of the most impressive ones we've ever seen in this country created 23.3 million jobs. This job loss number on the left was through last week. So you add 4.23 or 4.24 million more jobs lost this week to this number, and everything's gone since the Great Recession. Those are the data points that we wanted to cover on Monday Morning Minute. Next, we have some big news items that popped up this week. There is an unlimited amount of stuff that I could talk about right now, but we don't have an unlimited amount of time. And frankly, you guys don't want to sit and listen to me babble for an hour and a half or 2 hours. So we're going to try to consolidate this into what I think are the 3 most important news stories of the week. The first one is that states are starting to reopen. I mean, Trump, that's a little better. You guys see my pretty face. Trump was all over telling everybody that the states are going to reopen, right? Really excited about that. Now we have Georgia and Tennessee and Florida. Everybody is getting into it. They're ready to reopen. Colorado, I guess, is going to have some non-essential business start opening up tomorrow, and then going to start removing some shelter-in-place restrictions on May 4th, just in time for us to party for Cinco de Mayo or whatever. All that's good, and I'm excited too because I'm antsy, right? I'm hanging out down here in the middle of nowhere, looking at turkeys and deer out the window while I'm working every day. So I'm ready for things to get going too. But I want to caution everybody. This right here is a chart of Singapore. They are about a month ahead of us. If we can look back to where the yellow line and the purple line start to diverge, it looks like the very end of January to the beginning of February. That's when Singapore started getting their first cases of coronavirus. And if you guys have been watching the news, you know that Singapore was incredibly aggressive in trying to shut down their economy. They put shelter in place in immediately. They had incredibly aggressive sanitation procedures mandated throughout the entire island. It was crazy how aggressive they were. And they were able to slow the spread rapidly, much faster than us. And I mean, they're a much smaller country, but they did a really good job. And they opened up partially about a month ago. And if we look at the trend line down, the peak to trough was pretty big in Singapore, but it wasn't shocking. What is a little bit shocking is the rate of their recovery, because over the last couple of weeks we started to see a spike in coronavirus cases there again, and they didn't experience the same amount of a recovery we've seen so far here in the United States. Hence, at this point, right now, as we live and breathe, their market is still down over 26% on the year, where the S&P is only down 12.95 or so. Moving on to the next piece here, we got oil. Oh, this is a good one. Oil is a total dumpster fire. I know that I've received a lot of questions about this, but I want to point out a few things before I get to the questions specifically. Number one is going back to February, I guess early March, we had Saudi Arabia and Russia decide they were going to start an oil price war. What that means exactly, it remains, well, I guess it's still up for debate on what their true intentions were. But if you read the blog that I wrote a little over a month ago about this, I was specifically talking about how Russia and Saudi Arabia didn't really want to hurt each other that bad. They were really waging a price war on U.S. shale producers. We have a significantly higher break-even point on our oil here. For our horizontal frackers, it's somewhere in the low 40s. Just to break even and not lose money on pulling the oil out of the ground. If we look up towards Canada and the oil sands, I mean, they're somewhere in the high 70s, low 80s to break even. So ultimately, Saudi Arabia and Russia wanted to take other sources of oil offline, and they wanted to do it forcibly. What they didn't count on is a massive reduction in consumption. Their timing was real bad, which is why they came to the table to negotiate a little bit with the administration last week, and they agreed essentially to reverse course, and Mexico jumped on board, and we're subsidizing that a little bit, and that's a story for another day. But the long and the short of it here is the whole thing's a mess. This kind of brings me to one of the questions that I've been getting over and over, and it's how can a barrel of oil cost negative dollars? Well, it's kind of a loaded question, but it's not that hard to answer. It has to do with the futures market. Oil for immediate delivery is a scenario where, let's say I hold a futures contract for May delivery on 1,000 barrels of oil. Well, I'm down here in the middle of nowhere with 2 small children and a wife, and I'm stuck with this contract. and there's no buyers out there. Nobody wants to buy this contract from me to take delivery of oil because there's nowhere to store oil anywhere on the planet. The tankers are floating around in the ocean. They're full. All the strategic reserves are full, except for the United States. And I don't want to get into that because we don't talk politics here, but we might, but not this week. There's really nowhere to put it. And with demand dropping a projected 5 to 6 million barrels a day on average for the calendar year at this point, and an oversupply of the last month of roughly 10 million-ish barrels a day, that gives us a delta of 15 million barrels a day for over a month and moving forward that needs to get erased before we see some real value in oil prices. Anyway, back to what I was trying to get at with the futures market. If I'm stuck with that contract, the long and the short of this thing is I don't want it delivered on my front porch. I don't have anywhere to put it. So the solution is I got to pay people to take this away from me. Somebody's got some warehouse somewhere that they decided they were totally cool with getting paid $35 a barrel to take delivery of this oil, and they'll just hold on to that or something until oil is valuable again, and they can sell it off into the market when there's demand and there's a real place to store it. But that is the bottom line on oil. That's how it costs negative dollars. When you get stuck with that contract and you have to take delivery and there's no buyers for that contract, you got to pay people to take it away from you. That's why we bottomed out at negative $35 a barrel in the futures market on immediate contracts. Sorry, still not that good at this stuff. I'm working on it. The last piece of news that I thought was really pertinent right now is actually popped up today, and it has to do with Gilead. I am not making a recommendation to buy or sell this company. I don't care what you do. All I'm doing is reporting the news here. Apparently, the World Health Organization decided they were going to post an article that may or may not be true, saying that remdesivir, or however you pronounce that drug, doesn't work to treat coronavirus. Gilead came out and said that was fake news and that they don't have definitive results yet. And I don't know. I'm just a messenger telling you that things can change rapidly, and that's an example I wanted to provide. Things can change incredibly rapidly in this market, and there's really no way around it. Fake news is going to come out, and people are going to refute it. You're not going to know what's necessarily true. That's why this is a market that you need to be nimble in, and you got to be patient. Jumping to conclusions really only has a tendency to have you lose money in markets like this. Now that we've knocked out the news piece that I wanted to cover, I'm going to take some questions. We had some good questions come in. The first one was really, really solid. It says, what is going to replace bonds in a diversified portfolio if and when interest rates go to zero and possibly negative territory? What a great question. From my perspective, bond prices are relative. In this case, we've already seen sovereign debt across the world go negative, right? Think about German bonds or Bunds. They've been trading at or around negative territory for years now. Same thing in Japan. And really, what happens is for investors in those places, they try to find relative value. And that can come from currency strength or just trying to chase yield somewhere else. In this case, a lot of those investors came to the United States and they bought treasuries. That's why even when the Fed was raising rates a couple of years ago, you saw rates move very, very, very slowly. It's because there was huge demand overseas because the dollar was really, really strong, and they had negative yields there. So what they were going to sit around and they're going to pay their government to keep their money safe, or they could go out and they could find relative value. So my answer to that question is, if by chance rates go to negative here in the United States, we'll find value elsewhere, whether it's currency related or sector related or some other sovereign debt that provides a safe return for us. We'll find it elsewhere. The next question we had was interesting as well, and it has to do with Japan, and we just mentioned it. So what a great segue! You'd almost think I was a professional or something. Um, the question is, it's two parts. It says, do you have any thoughts on hyperinflation? And do you see any similarities with our economy and Japan's economy 30 years ago? Um, let's talk hyperinflation first. Answer to that question is no. I don't see hyperinflation being a thing here in the United States. We are not Argentina, right? We're the world's reserve currency with a highly productive workforce. Um, we we theoretically are purely consumption driven. Over 70% of our economy is consumption driven, and when we talk about being the reserve currency, that means the stuff that we're consuming is priced in dollars, and it's priced in dollars all over the world, right? As the dollar remains strong, even with the Fed printing money all the time, other major currencies in the world are experiencing the same type of printing. Um, and this kind of goes back to the bond thing as well. I mean, it's all relative, right? Could we see some kind of inflation in the future? Possibly, but it's more likely that we won't see any inflation until there is reasonable wage inflation again. And reasonable wage inflation isn't going to occur until we run into jobs getting to the point where there's competition. And with pushing 30 million new unemployment claims over the last month or so, I think it's going to be a while before we get into that position. In terms of Japan, um, yeah, I mean, if we look at charts in GDP growth numbers, et cetera, I mean, there are some similarities, but Japan's a frickin' island, and they have a demographics crisis. The United States, even with all the bombastic rhetoric coming from the administration, we are a huge country with enormous amounts of land and enormous amounts of uh, free space to populate per se. We also are a country of immigrants, and people are going to come here illegally and legally, and they're going to help keep our average age down, which gives us an opportunity to continue to grow into the future and expand with global demand growth. Japan has been maxed out for the better part of 2 decades because they simply don't have anywhere to put anybody, and their average age is in the mid 40s because they have a really low birth rate as well. So there are similarities, but what gives us a major upper hand is the fact that we have empty land and we have immigrants coming in and a place to put them. Um, that may change in the future. I don't know. But as we live and breathe right now, I don't think we have a huge similarity to Japan. So, but thanks for that question. It was awesome. Something I'm going to do every week is I'm going to end with a final thought. And to be completely candid with you, it's going to be more of a rant. Any of you guys that know me, you know that I love to go off on a tangent when I think something is wrong or I have deep-seated feelings about it. And the focus of my rant this week is going to be the Federal Reserve. You may think that I'm going to start going into a tirade about Federal Reserve bailouts, and I have thoughts on that. If you think back to 2008, bailouts of big banks, maybe people didn't like it. Maybe people thought it was great. I really don't know. I don't have a huge opinion on that, but at least you can understand why we wanted to bail out, or the Fed wanted to bail out large financial institutions, because we needed to keep some sort of faith or hope or belief structure in our biggest banks because they are the core lending facility here in the United States, and that drives growth, right? Um, the issue I have right now is bailouts with airlines. I'm not sure about that whole thing. I mean, airlines were really, really irresponsible with their money. And they spent a ton of money on stock buybacks. They ran razor thin margins. They're totally fine with firing and furloughing people. I mean, heck, some of these airlines already took their bailout money, furloughed people, and then reissued stock, basically wiping out all of the stock buybacks that they did over the last 8 or 9 years. I mean, the whole thing seems weird to me. But that's not even the thing that really makes me angry about what the Fed's doing right now. The Fed's breaking its own rules. I mean, I'm an asset manager, and for me, I have to follow a set of rules. So I do a ton of research. I do due diligence. I work my butt off trying to be informed and make intelligent decisions within the framework of the regulations that I have to deal with. And then the Federal Reserve comes out and they decide they're going to bail out high yield debt. They're not really bailing out mom and pop with a restaurant down on the corner that they net out $40,000 or $50,000 in a year to feed a family of four. No, they're not bailing out them. They're bailing out gigantic hedge funds that make stupid leverage bets using high yield bonds and borrowed capital left and right. And they're making these bets on things that have a 50-50 chance of failing or worse, thinking they're going to make a 10 or 20x return, knowing that most of them are going to fail, but the ones that win are going to make up more than make up for the ones that fail. And the Fed's sitting there bailing them out. I'm going to save you guys a little bit of reading, and I'm going to give you a quick synopsis of the most important point of the Federal Reserve Act of 1913. Okay? The Federal Reserve is only allowed to hold sovereign debt on its balance sheet. More specifically, and back then what this meant was U.S. Treasuries. Anybody see anything weird about this scenario? Because it's really bothering me. I mean, we're in an incredibly regulated society, and I'm in one of the most regulated industries on the planet. I don't think anybody would disagree with that. But we have the Federal Reserve out here breaking its own rules, trying to drive growth or put a stopgap underneath people, incredibly rich people, and incredibly rich corporations that are simply greedy. I mean, they're even going out there and they're buying high yield ETFs right now, trying to stabilize the market. I just have a problem with that. And with that, I think it's time for us all to enjoy our happy hour. I'm hoping you guys were watching this video with a beverage in hand with your loved ones, and I hope that it gave you guys just a little bit of insight into what's going on, what my thought process is. And it's my goal to get better and better at this over time, but I want to do this for you guys every single week so we have an opportunity to share our thought process here at Capital Financial Group. You can get inside my mind a little bit, and we can enjoy a happy hour together. So with that, cheers. Look forward to seeing you guys on the Monday Morning Minute, and then again live next Thursday. Please send in the questions that you guys want me to ask at some point during the week. We only got a couple this week, but they were great. Don't forget to like and subscribe. And thank you so much for watching our inaugural Thursday Thoughts video. Y'all take care.